So today, we're going to decode this fascinating tug-of-war that's happening in the markets. I mean, on one side, you've got this incredible, unstoppable force of AI hype just pulling everything skyward. And on the other, you've got this heavy, heavy anchor of Wall Street skepticism, holding things firmly to the ground. Let's dive right into that tension.
And there's really no better place to start than with the sheer mind-boggling scale of ambition we're seeing in the tech world. I mean, this quote from Meta's CEO Mark Zuckerberg, this isn't just about building a better app. It's about fundamentally rewiring our future, with the goal of putting a personal superintelligence into the hands of literally every single person. The vision is just massive.
And visions that big, well, they require equally big money. We're talking $135 billion. That's Meta's planned capital spending for this year alone. And that number is actually doubled as the company goes deeper into its partnership with the chip giant NVIDIA. They're planning to buy millions of their processors to power this AI revolution. It's just an incredible, incredible level of investment.
So yeah, this really sets the stage for our first big theme. We're in this period of what feels like boundless investment, where companies are just pouring billions into AI models, into data centers, into the next generation of computing. It's creating this powerful current that's frankly really hard to ignore.
Well, that is the multi-billion-dollar question, isn't it? Because while Silicon Valley is clearly all in, there's another really powerful group of players. We're talking investors on Wall Street who are kind of starting to pump the brakes. And this is where our story gets really, really interesting.
I love this metaphor because it just perfectly captures the market's current mood. Just picture a giant hot air balloon trying to take off. That's all the AI hype, right? But it's tied down by this thick, heavy rope made of doubt, concern, and a very healthy dose of financial caution.
Okay, so let's take a closer look at that rope. This wall of worry. It's built from a few key bricks. You've got major concerns that tech valuations are just simply too high. There's anxiety about the massive corporate debt being taken on to fund all this expansion. And then there's just this general nervousness from some pretty extreme market swings.
And here's the data that really backs up that nervousness. Get this, in the last 3 months, more than 30% of the stocks in the S&P 500 have swung by over 20%. That is one of the highest levels of volatility we have seen in decades. It just goes to show how jittery the market is. When prices get this high, it really doesn't take much to cause a huge swing.
So, if the big money is getting a little hesitant about purely digital tech, where does it go? Well, some analysts at JP Morgan have come up with a really compelling new framework for this potential shift in focus. It's all about a move away from the cloud and towards concrete.
Let's break down this acronym, HALO. It stands for Heavy Asset, Low Obsolescence. And the idea is pretty straightforward. Invest in tangible, real-world things. We're talking about companies that build the physical infrastructure of our world, in sectors that are way less likely to be made obsolete overnight by some new piece of software.
And this makes the contrast so clear. On one side, you've got the digital world, all code, data, algorithms. But on the other, you have the halo world. Think about the companies that physically build the robots for our factories, or the utility companies that maintain our power grid, or even the brands that make the essential stuff we always buy no matter what. These are tangible assets, things you can actually see and touch.
Now, this whole debate between the digital and the physical, it doesn't happen in a vacuum. The big decisions made by the world's central banks, especially around interest rates, could ultimately be the thing that determines which of these trends wins out.
And right now, there is no clear answer, especially not from the U.S. Federal Reserve. I mean, you have members like Governor Barr urging caution, basically saying, hey, it's too early to declare victory over inflation. But then, on the very same day, you've got Chicago Fed President Goolsbee suggesting that multiple rate cuts could be coming soon. This kind of division creates a ton of uncertainty for investors.
So now let's shift our focus over to Europe, because the uncertainty there isn't just about economic data, it's getting into politics and leadership. A whole new variable has entered the equation that could have some pretty major implications for the European Central Bank.
So reports have started to surface speculating that the ECB president, Christine Lagarde, might actually step down before her term officially ends in late 2027. And the suggested motive? To time her departure before the next French presidential election, which could potentially influence who gets to choose her successor. It's this whole political chess match that just adds another layer of unpredictability to global monetary policy.
Of course, the official line from the European Central Bank is a firm denial. This statement was put out almost immediately, trying to shut down all the speculation. But you know how markets are. Sometimes the perception of instability can be just as impactful as the real thing. So the crucial point is,
How do we make sense of all this? We've got this incredible technological optimism on one side and some really deep-seated financial and political uncertainty on the other. For any investor, trying to navigate this means you have to understand the core tensions at play.
Let's just boil it all down to 3 key battles you need to watch. First, it's the incredible hype around tech versus the cold, hard reality of its high valuations. Second, it's that potential rotation of capital from the purely digital world over to the physical halo world. And third, you've got these conflicting signals coming from the US Fed clashing with the new political uncertainty brewing in Europe.
And that really brings us to our final thought. The market is in a massive tug of war. One rope is pulling us towards a future that's defined by artificial superintelligence. The other rope is anchoring us in the realities of today's economy and its politics. So the question for every investor is this: which rope do you think has more pull?